This video won't tell you which stocks to buy in 2025. It won't promise you the next Tesla or the next 10-bagger, but here's what it will do. I'm going to show you the exact framework professional investors use to analyze stocks. The same process used by analysts at Goldman Sachs, portfolio managers at Fidelity, and value investors like Warren Buffett. By the end of this video, you'll understand how to evaluate investment opportunities independently, rather than chasing hot tips on Reddit or following random Twitter accounts. This is information-dense content. You might want to hit that like button and save this video. You'll probably want to come back to it. Let's dive in. When people think about stock analysis, many immediately think of charts. You know what I'm talking about. Those traders on YouTube pointing at screens saying, "See this head and shoulders pattern? That's a bullish signal." This is called technical analysis, using historical price data, volume, and chart patterns to predict future price movements. Here's my take. For the average retail investor, technical analysis is a losing game. Let me explain why. Right now, as you're watching this video, there are quantitative hedge funds running algorithms that can execute thousands of trades per second. These aren't day traders in their basements. These are firms like Renaissance Technologies, Citadel, and Two Sigma, employing PhDs in mathematics, physics, and computer science. They're using machine learning models with names like Iceberg and Ninja to detect microscopic supply-demand imbalances in real time. And it's not just price data anymore. A friend of mine works as a data engineer at a major quant fund in New York. His job? Text mining. They're analyzing news articles, Twitter sentiment, Reddit posts, even satellite images of parking lots to predict retail sales, all converted into trading signals within milliseconds. So when you're trying to spot a double bottom on your Robinhood app, you're competing against supercomputers and billion-dollar algorithms. It's like bringing a knife to a gunfight. Here's a fundamental truth. Prices are driven by supply and demand in the short run, but by value in the long run. Technical analysis works best for capturing short-term fluctuations. But for retail investors, frequent trading is a wealth destroyer. Every trade costs you money in commissions, spreads, and taxes, unless you're planning to day trade full-time, which statistically, about 95% of day traders lose money. Technical analysis has limited value for long-term wealth building. Sometimes technical analysis seems to work, but not for the reasons you think. Imagine a stock repeatedly bounces off $100. Traders start believing $100 is a resistance level, so next time the stock approaches $100, everyone expects it to fall and they sell, causing it to actually fall. This creates the illusion that technical analysis works, but it's just mass psychology, not fundamental value. And the moment the stock breaks through $100, all those rules go out the window, and traders who relied on them get crushed. For most individual investors building long-term wealth, fundamental analysis is far more reliable than technical analysis, and that's what we're focusing on today. Fundamental analysis has 3 layers: macro, industry, and company. Miss any one of these and you're flying blind. Let's start at the top. A lot of investors skip macro analysis. They think, "I just want to pick good companies. Why do I care about GDP or interest rates?" Here's why. The macro environment determines whether you're swimming with the current or against it. Let me show you what I mean. From 2009 to 2021, the S&P 500 went up, up, and up. If you bought almost any stock after the 2008 financial crisis, you made money. People thought they were investing geniuses. But were they? Or were they just riding an unprecedented macroeconomic wave? 3 macro forces created that bull market. First, quantitative easing. After the 2008 crash, the Federal Reserve injected trillions of dollars into the economy. When there's more money in the system, asset prices rise. It's that simple. The money had to go somewhere, and it flooded into stocks. Second, corporate tax cuts. The Trump administration's Tax Cuts and Jobs Act of 2017 slashed corporate tax rates from 35% to 21%. Companies kept more profit, which boosted earnings and stock prices. Third, global capital flight. Europe was a mess. Japan was stagnant. China was uncertain. Where did global money flow? Into U.S. markets, the safest, most liquid market in the world. Your neighbor who brags about his stock returns? He wasn't necessarily smart. He was just in the right place at the right time. The macro environment did the heavy lifting. The single most important question: how much money is in the system? The Federal Reserve controls this through interest rates. Low rates make borrowing cheap, flooding the economy with money. Quantitative easing is direct money printing, buying bonds to inject cash. Reserve requirements determine how much cash banks must hold versus lend. When liquidity is abundant, stocks go up. When it dries up, stocks go down. It's not complicated. Economic growth indicators include GDP growth. Is the economy expanding or contracting? Unemployment rate, especially non-farm payrolls, released monthly. Inflation, measured by CPI. Too high crushes margins. Too low signals weakness. Some indicators are surprisingly predictive. Former Fed Chairman Alan Greenspan famously tracked men's underwear sales. Why? Underwear is a necessity. Sales are stable. But during recessions, men delay replacing underwear. Sales drop. When sales start recovering, it signals economic confidence is returning. It sounds ridiculous, but these quirky indicators often reveal consumer psychology before official data does. In professional investing, the first step is called asset allocation, deciding which countries, asset classes, and sectors to invest in. Only after that decision do you pick individual securities. For retail investors, this might mean choosing between U.S. stocks versus international stocks, deciding stock versus bond allocation based on interest rate environment, or selecting sector ETFs based on economic cycle. The point is, don't fight the macro tide. When the Fed is tightening and liquidity is drying up, even great companies struggle. When money is flowing freely, mediocre companies thrive. Here's a stat that should change how you invest. In 2020, tech stocks in the S&P 500 returned over 40%, while energy stocks lost more than 30%. That's a 70 percentage point difference between sectors, far bigger than the performance gap between most individual stocks within a sector. Translation: picking the right industry matters more than picking the right company. You could have bought the second best tech company and crushed the best energy company. The racetrack matters more than the horse. Every industry goes through stages. Emerging stage has high risk, high reward. Technology is unproven. Think early stage AI, quantum computing. Growth stage sees rapid expansion. This is where the money is made. Think streaming services 5 years ago. Electric vehicles 3 years ago. Mature stage has slow, steady growth. Competition is stable. Think traditional automotive, consumer packaged goods. Decline stage is being replaced by new technology. Avoid at all costs. Think print media, traditional retail malls. Cyclical industries like construction, automotive, luxury goods boom and bust with the economy. Defensive industries like healthcare, utilities, consumer staples stay relatively stable regardless of economic conditions. During economic expansion, buy cyclical. During uncertainty, defensive sectors protect wealth. High-barrier industries like pharmaceuticals, aerospace, banking require massive capital, regulatory approvals, or proprietary technology. Competition is limited, profit margins are high. Low-barrier industries like restaurants, e-commerce, apparel face constant new competition. Margins get competed away. Warren Buffett famously looks for companies with moats, competitive advantages that keep competitors out. Never underestimate policy impact. Case study: the Inflation Reduction Act of 2022. This legislation poured hundreds of billions into clean energy, electric vehicles, and battery manufacturing. Stocks in these sectors surged on the announcement. Companies that position themselves to capture these subsidies, like solar manufacturers, EV battery producers, saw immediate valuation boosts. Meanwhile, traditional oil and gas faced increased scrutiny and regulatory pressure. The lesson: when government support flows into an industry, ride that wave. When government creates headwinds, get out of the way. Markets exhibit sector rotation. Different sectors lead at different points in the economic cycle. Early recovery. Cyclical stocks lead: industrials, materials, financials. Mid-expansion. Consumer discretionary, technology thrive. Late cycle. Energy often peaks. Defensive sectors start outperforming. Recession. Utilities, healthcare, consumer staples hold up best. Understanding where we are in the cycle helps you position correctly. Professional resources include brokerage research reports. Many brokerages offer free research to account holders. Industry association reports, consulting firm studies. McKinsey, BCG publish sector insights. The easy button is sector ETFs. Don't want to research individual stocks? Buy sector ETFs. Technology, XLK, Tech Select Sector SPDR. Healthcare, XLV, Healthcare Select Sector SPDR. Energy, XLE, Energy Select Sector SPDR. Financials, XLF, Financial Select Sector SPDR. One click, you own the entire sector. If you're right about the industry, you'll profit. Now we get to individual companies. This is where most investors start. But as you now understand, you should only reach this step after analyzing macro and industry. The fundamental question, what is this company's future earning power? A stock's value is simply the present value of all future cash flows it will generate for shareholders. Everything else is noise. Company analysis splits into qualitative and quantitative. How does this company make money? Is it sustainable? Apple. Hardware sales create an ecosystem. Once you buy an iPhone, you're likely to buy AirPods, Apple Watch, MacBook, iPad, and subscribe to Apple Music, iCloud, Apple TV Plus. It's a flywheel. Amazon. E-commerce operates at thin margins, but it feeds data into AWS, cloud computing, which operates at fat margins. The e-commerce side builds the moat. AWS provides the profit. Netflix. Subscription model with massive upfront content costs but high margins once amortized. Success depends on subscriber growth and retention. Understanding the model tells you what drives profitability and what risks exist. Where will future growth come from? New product lines, Apple entering automotive or AR/VR, market expansion, Starbucks opening thousands of stores in China, technological breakthrough, pharmaceutical company getting FDA approval for blockbuster drug, acquisitions, Microsoft buying Activision Blizzard to expand gaming. No growth means the stock will trade based on current earnings. Growth potential creates valuation premium. What protects this company from competition? Types of moats include brand power. Coca-Cola, Nike, Disney. Customers pay premium for the brand. Technology and patents. NVIDIA's GPU dominance. Qualcomm's chip patents. Network effects. Facebook, Visa, Microsoft. Value increases as more people use it. Cost advantages. Walmart, Costco. Scale allows lower prices than competitors. Switching costs. Enterprise software like Salesforce. Once implemented, painful to change. Regulatory barriers. Banking licenses. FDA approvals. Government-enforced moats. The smile curve theory says in a value chain, the highest profits go to the ends, R&D and marketing sales. The middle, manufacturing, has the lowest margins. Apple embodies this. They design products in California, high margin, market them globally with premium branding, high margin, but outsource manufacturing to Foxconn in China, low margin. This is why Apple's profit margins crush traditional manufacturers. They control the valuable parts of the value chain. Great management can turn around a struggling company. Poor management can destroy a great company. Examples. Satya Nadella at Microsoft. When he became CEO in 2014, Microsoft was seen as a dinosaur. He pivoted to cloud computing, open source, and subscription models. Microsoft's stock up over 1,000% under his leadership. Elon Musk at Tesla. Love him or hate him, his execution and vision transformed Tesla from a niche car maker into the world's most valuable automotive company. Adam Neumann at WeWork. Charismatic founder who nearly destroyed the company with reckless spending and governance issues. New management had to rebuild from scratch. Warren Buffett famously insists on meeting management teams before investing. He wants to see competence, integrity, and alignment with shareholders. After hearing the story, verify with data. The three core financial statements are the balance sheet, what the company owns, assets versus owes, liabilities, income statement, revenue, expenses, and profit for a period, cash flow statement, actual cash moving in and out, the most honest statement. Price to earnings ratio, PE, formula. Stock price divided by earnings per share, meaning how many years of earnings you're paying for. Important nuances. High PE isn't always bad, think growth companies. Low PE isn't always good, think value trap. Compare within industry, not across industries. Tech companies often trade at 30 to 50 PE, utilities at 12 to 15 PE. The market's average PE tells us about overall valuation. Looking at the S&P 500's average PE since 1990, 1999 to 2000 saw an extreme peak during dot-com bubble. 2008 to 2009 had a spike during financial crisis when earnings collapsed. 2021 to 2022 marked another historical high. When market PE is extremely elevated, it signals overall market risk. Individual stock selection matters less when the whole market is overvalued. Profit margins include gross margin, revenue minus cost of goods sold, operating margin after operating expenses, net margin after all expenses and taxes. Typical ranges: software companies 20 to 40% net margin, traditional retail 2 to 5% net margin, manufacturing 5 to 10% net margin. Higher margins usually indicate competitive advantage. Different industries require different metrics. Retail looks at same-store sales growth, inventory turnover. Real estate examines funds from operations, FFO, occupancy rates. Banks track net interest margin, loan-to-deposit ratio. SaaS companies measure customer acquisition cost, CAC, lifetime value, LTV, monthly recurring revenue, MRR. Streaming services monitor subscriber growth, churn rate, content spend per subscriber. You can't use the same metrics for every industry. Context matters. This is critical, and many investors miss it. A great company at too high a price is a bad investment. When everyone knows a company is great and piles in, the stock price gets bid up beyond reasonable valuation. Future returns suffer even if the company performs well. Investment opportunities come from information asymmetry. You see something the market hasn't recognized yet, or you disagree with market consensus. If positive news is already widely known, it's priced in, already reflected in the stock price. There's no opportunity left. Let me walk you through how a professional analyst actually evaluates an opportunity. Step 1 is the macro check. Where are we in the economic cycle? Example: early 2024. Fed has raised rates aggressively to fight inflation. Liquidity has tightened significantly. Recession risk is elevated. However, employment remains strong. AI boom is creating sector-specific opportunity despite macro headwinds. Conclusion: be selective. Avoid highly leveraged companies and cyclical sectors. Focus on companies with pricing power and strong balance sheets. Tech, specifically AI, may buck broader trends. Step 2 is sector selection. Given the macro environment, which sectors have tailwinds? Favored sectors include healthcare, defensive, aging demographics, AI infrastructure, secular growth story, energy, transition to renewables with government support. Avoid commercial real estate, office vacancy crisis, regional banks, deposit flight, interest rate pressure, discretionary retail, consumer under pressure. Step 3 is company analysis. Let's say you've chosen healthcare. Now drill down. Qualitative questions. Which companies have FDA approvals in pipeline? Who has pricing power in a potentially regulated environment? Which management teams have track record of capital allocation? Quantitative analysis. Compare PE ratios within pharma, biotech sector. Analyze R&D spending as percentage of revenue. Look at debt levels. Can they weather higher rates? Review cash flow generation. Can they fund development internally? Step 4 is ongoing monitoring. Investing isn't a one-time decision. Quarterly reviews include reading earnings reports and transcripts. Track whether thesis is playing out. Monitor for changes in competitive landscape. Reassess valuation as price moves. Red flags that require action: management departure, margin compression, increasing competition, regulatory challenges, deteriorating cash flow. This sounds great, but I don't have 40 hours a week to research stocks. What should I do? Fair question. Here's my honest answer. The 3-tier approach. Tier 1 is passive index investing, 80% of portfolio. Buy broad market ETFs. SPY or VOO tracks S&P 500. VTI is total U.S. stock market. VXUS is international stocks. This gives you diversified market exposure with minimal effort. Most active managers don't beat these indexes after fees. Tier 2 is sector bets, 15% of portfolio. Based on your macro and industry analysis, overweight specific sectors. XLK is technology. XLV is healthcare. XLE is energy. XLF is financials. This lets you express informed views without picking individual stocks. Tier 3 is individual stocks, 5% of portfolio. Only invest in individual companies where you have true edge. Maybe you work in the industry, have unique insights, or have done deep research. This allocation protects you from behavioral mistakes while allowing for potential outperformance. Free resources for company information include sec.gov, read actual 10Ks and 10Qs, company investor relations websites, earnings call transcripts, available free on Seeking Alpha. For research, brokerage research from Fidelity, Schwab offer free reports to account holders. Morningstar basic membership, Yahoo Finance for basic data, Fred, Federal Reserve economic data, for macro indicators. For education, Investopedia for term definitions. Berkshire Hathaway annual letters, free investing education from Buffett. Company 10Ks are the best way to learn an industry. Let me save you from expensive lessons I learned the hard way. Mistake 1 is ignoring macro and industry. The most common error is buying a great company in a terrible industry or during a macro headwind. Example, buying the best department store chain in 2015. Doesn't matter which one. The whole industry was getting destroyed by e-commerce. Mistake 2 is chasing hot stocks. By the time you hear about the hot stock on Twitter or CNBC, the move is probably over. You're buying from smart money that's selling. Meme stocks in 2021 taught this lesson expensively. Mistake 3 is overconfidence. Thinking you can consistently beat professional investors. Even most professional money managers underperform index funds. Stay humble. Accept that much of investing success comes from discipline, not genius. Mistake 4 is short-term thinking. Trading in and out based on daily news. Not only do transaction costs add up, but you're paying short-term capital gains tax at ordinary income rates. Wealth is built by holding quality companies for years, not flipping stocks for weeks. Mistake 5 is falling in love with a stock. Your investment is a business relationship, not a marriage. If the thesis breaks, sell. Don't hold out of loyalty or hope. We've covered the complete stock analysis framework today. Layer 1. Macro. Understand the economic environment and liquidity conditions. Layer 2. Industry. Pick sectors with structural tailwinds. Layer 3. Company. Analyze business model, moat, growth, and valuation. This framework won't make you rich overnight, but it will help you make rational, informed decisions instead of gambling on hot tips. Core principles to remember. Technical analysis has limited value for long-term investors. Macro always matters. Don't ignore the big picture. Industry selection often matters more than stock selection. Great companies can be bad investments at wrong prices. Long-term compounding beats short-term trading. In the next episode, we'll do a deep dive on reading financial statements. I'll show you how to spot red flags, detect potential accounting fraud, and understand what the numbers really tell you about business health. If this was helpful, like and subscribe. Drop questions in the comments. I read and respond to as many as I can. Final reminder, this is education, not investment advice. I'm not your financial advisor. Do your own research. Invest at your own risk. See you in the next one.